Live from Studio 2 here at Bloomberg's headquarters in New York, I'm Sonali Basak.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. I am pleased to report that it is Friday, so happy Friday to us all. And a happy Friday to these markets. We are looking at a big rally on our hands. The S&P 500 currently up about 1.2%. Even more dramatic, you take a look at the NASDAQ 100 up about 1.7%. We got some hotter than expected inflation data this morning, but it wasn't as bad as it could be, I guess. At least that's the message behind the narrative today. You take a look at the small cap index, the Russell 2000, also seeing a bit of a relief rally here, currently up about 1.1%. And that love is spreading to the bond market as well, Sonali. You take a look at 10-year Treasury yields, currently down by about 3 basis points.
And we're looking at U.S. stocks heading into their best week of the year, Katie. Tech heavyweights, Microsoft, Alphabet are sending a clear message to investors, and that is that AI bets, they're paying off. Meanwhile, over in Japan, the yen is sinking to a fresh 34-year low against the dollar after the Bank of Japan signaled policy will stay easy and, of course, amplifying speculation that authorities may intervene to stop the decline. And back in the United States, the Fed's preferred inflation gauge, core PCE, staying sticky, indicating progress towards the central bank's 2% goal has stalled and flaming concerns that the central bank may push off rate cuts further out.
And you take a look at how that pricing is being worked out in the markets right now. As it stands, the first Fed rate cut this year is priced into the November meeting. About 24 basis points of easing are priced in. I'm going to go ahead and call that a quarter-point cut. You take a look at the full year, the amount of easing priced in through December, we're at about 34 basis points. So we're talking about one cut and a little bit more, Sonali. Of course, we've seen this pricing sort of wiggle a little bit after this data that we got this morning. Again, a hotter than expected inflation print, but after what we saw with GDP and the big blowout we saw there when it came to expectations, maybe a bit of a relief that it wasn't too much worse than expected.
Now let's kick things off over here with Brian Jacobsen. He's chief economist over at Annex Wealth Management. We're talking about how stocks are ending on a high note, but of course that comes after a really tough tape last week. How do you think about this rally driven off of the earnings we saw in the tech sector here and how much it has the potential to really last?
Yeah, thank you for having me. And I think that really enjoy it while you can. One of our themes coming into this month was the idea about April showers bringing May flowers, and that we would perhaps have a better opportunity to enter some of those positions that we do like for the long term. And maybe the market has given that to us. Not quite sure we're out of the woods yet, especially given what's on the calendar for next week. Could be a very exciting week in terms of the FOMC meeting. We get the employment situation report. But so far, it does seem like some of the rally that we're seeing, it has broadened. We know that it's not just about, 7 particular stocks anymore. We've seen small caps doing pretty well. And so we are really optimistic about the outlook for the longer term, though we do still think that there's a little bit of tough sledding ahead, especially when it comes to the economic data.
So let's talk about that a little bit more, the concept of enjoy it while you can. I have to say, Brian, I was surprised that all of a sudden we're looking at the best week for the S&P 500 this year. It feels like the sentiment really doesn't match what we're seeing in the price performance. So now it sounds like, is it time for caution?
Yeah, it does actually. The numbers are better than how it feels, right? And I think it's just because we were almost lulled into a sense of complacency as far as with low volatility, and then suddenly it comes back with a vengeance. It maybe felt a little bit worse than what it actually was just because of how low volatility had been. And we are still digging out of that hole. Remember, small cap stocks are still well off of their peak where they were back in, I think it was around October 2021. We're even off of the peak as far as where we were back at the end of March, not too long ago. So, we do want to see some of that broader participation and continuation with the small cap, mid cap, maybe on the value side, some of those more cyclical areas to suggest that this does have a little bit more staying power. Instead of being driven by the Magnificent Seven, now it's maybe the dynamic duo in terms of Alphabet and Microsoft. So we do want to see a little bit broadening here.
It's interesting because any bid that you had in the bond market earlier today is now waning on the short end of the curve. You have the 2-year yield now standing around 4.99, just under 5% once again. At what point, Brian, does the ride higher in yield start to take a bite out of the market a little further?
Well, it has already taken a bite out of parts of the market, right? Small cap value, that's the area that tends to be the most heavily levered. And so as a result, that's already demonstrated its interest rate sensitivity. It's more the larger cap companies that have been able to term out their debt. They don't have the same debt burden. So you have, I think, already seen it take the bite out of parts of the market, just not out of the biggest names out there yet. Will it take a bite out of them? Probably not. I mean, they generate so much free cash flow that not only are they able to invest billions of dollars in artificial intelligence, but also pay a dividend now all of a sudden. So, I think we've already seen it take a bite out of the parts of the market where it's going to. Those are the companies that when we talk to the management, they've already tried to basically improve their operational efficiency in the face of the higher interest burden that they're really exposed to.
Yeah, Brian, you think about the dichotomy in markets right now. You have the small cap sector, which really needs these rate cuts, it feels like. And then, like you said, you have the mega cap tech companies. And actually, I was talking to Seema Shah over at Principal Asset Management earlier this morning, and she described that space, your big tech stocks, as sort of macro agnostic, that they're basically going to be your all-weather sort of strategy. Would you agree with that?
To an extent, yes. I do think that a lot of them, they have so much heft and such a global presence that they aren't necessarily beholden to, a downturn or a slowdown in China or a downturn or slowdown in Europe or even in the United States, as long as it doesn't happen in a synchronized way. And I think that's the key thing, is they aren't macro agnostic provided that we don't have a synchronized downturn. Now, will we? No, I don't think so. I think that really we already have seen Europe. They were in a recession. Maybe they're beginning to get a footing here where they can start a recovery process. China, they had their challenges. Maybe they're going to get a little bit of traction as well with some of the stimulus they've had. So even if we do get a tightening of the screws on U.S. consumers here and a slight slowdown in growth, they're probably somewhat well insulated from those effects.
Brian, it's interesting, outside of the tech sector, of course, energy has been one of your best performers in the S&P this year, but not today. And of course, we've had some earnings, including Exxon, that weren't as exciting as many people would have thought them to be in the first place. I mean, how do you think you play the energy sector from here, given all of the volatility around energy prices right now?
Yeah, it really is a case of the valuations, I think, as far as taking that longer term view, as far as the way in which the market is paying for those earnings. It's one of the few areas that it seems like they're not necessarily at, like in the top quartile in terms of their valuations. So it's an area that we are still optimistic about for the long term. It seems like they don't necessarily want to invest too much for growth. But there are those cases where Exxon's one, but then you can also see other examples of maybe some of the smaller players where they actually delivered a few beats. So it seems like, is Exxon necessarily going to be driving all of the energy sector? Maybe if you're in an ETF that is market cap weighted, but not necessarily if you're going in and picking out the names one at a time. So we still are optimistic about the outlook for energy, broadly speaking, even if we don't see oil prices continue their ascent here.
Brian, we thank you so much for your time and for being so versatile on a fairly volatile market here. That is Brian Jacobsen, Chief Economist over at Annex Wealth Management. Now coming up, Snack Crackle and a big pop. Why shares of the social media platform Snap are surging today, snapping back from the doldrums, how they plan to keep the momentum going.
Plus, Intel CEO says that they're making, quote, steady progress towards their priorities after tepid near-term guidance. It seems that investors, though, not convinced. We'll get into the details in our Stock of the Hour.
And consumers still feeling the inflation squeeze more than ever and losing hope that prices will fall anytime soon. More on the University of Michigan's Consumer Sentiment Survey. All that and more coming up. This is The Close on Bloomberg.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
let's head to the world of FX because the yen hitting a fresh 34-year low against the dollar. That's after the BOJ held interest rates steady and signaled that monetary policy will stay easy, which of course amplified concerns of possible currency intervention. Bloomberg FX and rates reporter Carter Johnson joins us now on set on a Friday afternoon, a hero. Let's talk about how the BOJ fits into us. Tell us about the timeline here.
Yeah, thank you so much, Katie. And you exactly said it. So they met Friday overnight for us. And the big takeaway was they held rates steady, which was mostly expected by economists. But again, it was a real reinforcement of, if you go into WCRS on the Bloomberg terminal, you can see that rates in Japan, very low still. Rates in the US, very high. And it was just really underscored that gap in yields, which is on offer for investors, that really has been driving the yen so weakly.
It's crazy because a couple days ago at 155 against the dollar, we were talking about that as almost a danger zone. And now we're sitting here past 157, edging 158. How do you make sense of that?
Yeah, for sure. We were, Sonali. And, I think, again, we've talked a little bit about maybe the levels aren't as important as the speed. But now that we're here at 157, almost 158, when we were at 155 just a few days ago and even lower, even a few weeks ago, that is a very fast move. And so we're talking about a move of maybe 5 yen in the matter of weeks. And that's where you start to wonder, is this fast enough to warrant some sort of support or intervention?
I remember when 7 was supposed to be a line in the sand for the yuan against the dollar. It feels like a long time ago. But talk us through potential currency intervention here. What would that possibly look like? And does it have any shot of being successful?
Sure, yeah. So we can look to recent history, which would be the fall of 2022, 2 years ago, a year and a half ago. And at that time, Japan spent around maybe $60 billion supporting the yen. At the simplest level, it's a matter of buying yen and selling dollars. At the time, they sold some treasuries, also maybe sold some deposits. They have deposits at foreign central banks around the world. But that's kind of at the most fundamental what it would look like. Whether it would be successful or not, it's a great question. Back then, the U.S. was kind of at the beginning of a monetary cycle. Now we're very much on hold. So the environments are quite different than they were, back in 2022.
How do you think about the Bank of Japan's communication at this point? What do we know about what they've really said already in terms of how willing they are to actually intervene, particularly, Carter, because we've been talking about an intervention for days now and we haven't seen it? Yeah,
I think the Japanese authorities, I think part of their MO is to keep a little uncertainty in the market. And it's kind of funny, if you look at the Bank of Japan's policy statement today, very short, all of maybe 2-3 sentences, which is very different from what we're kind of used to in dealing or in thinking about the Fed. So I think they're willing to accept a lot of that uncertainty and sort of keep the markets and keep traders on edge in the hope that maybe that'll do some of the work for them.
What does this mean for the carry trade? Obviously, one of the most popular currency trades out there, and the yen being such a popular funding currency, this weakness, how does it factor in?
Yeah, it's a great question. And if you look at positioning of currency traders, there are a lot of yen short positions out there. And that is indicative of the carry trade and the endurance of that, even with the idea that the Bank of Japan is tightening policy, et cetera. We'll actually get new positioning data in about 15 minutes, and we'll see whether traders are pulling back on those short yen positions a little bit, just because of maybe a fear of intervention. But so far, that carry trade does not seem to be going away. It has a lot of staying power.
Carter, thanks for keeping an eye on this story for us so closely all week, as we have seen the yen weaken throughout the full week. Carter Johnson, Bloomberg FX and rates reporter. Now, coming up, we're going to talk about Snap shares surging as the social media giant signals its digital revamp is paying off. We're going to have the view from an analyst in Top Calls today. Stick with us. This is The Close on Bloomberg.
All right, it's time now for Top Calls. Look at some of the big movers on the back of analyst recommendations. And we start with Hertz. Bank of America making a U-turn on the stock with a downgrade to underperform from neutral. The rental car company's first quarter results disappointed the analyst, who says that liquidity, an increasing concern among investors due to its older fleet needing to be refreshed at a time when new and used car prices are softening. You take a look at shares right now, currently down about 4%. Next up, we have Caterpillar downgraded to hold from buy at Stifel after a, quote, modest first quarter. Price target, though, raised to $350. The heavy equipment maker warned investors of a slowdown in machinery sales, to which the analyst says could amplify near-term and cap expansion opportunities. You take a look at shares right now, they're actually a little bit higher, currently about 1.7% higher on the day. And finally, we have Spotify. Philips Securities raising its recommendation on the audio streaming service to buy from Accumulate. Price target set to $340. And analyst Jonathan Wu says that it continues to solidify its place as a leader in the industry with a growing subscriber base, lower cost structure, and pricing power. Shares right now, they're pretty much unchanged. And those are some of our top calls. Snap also finding a growing audience. Its efforts to revamp its digital advertising business really helped to drive revenue in the most recent quarter. Joining us now for more, we have Rohit Kulkarni. He is senior analyst covering internet and capital markets research over at Roth Capital Partners, and he has a neutral rating on Snap. So that's where you are right now after, of course, what we learned from Snap earnings. Are you considering bumping up to buy?
I can't say that here, but we definitely have a growing positive bias. In sell-side speak, what that means is if they can do this one more time, if they can durably execute in a way that Snap has executed in first quarter, I think not just me, many other people would be looking to upgrade this stock. But having said that, I think the turnaround in the story is real. They have executed improved traction with direct response advertisers. That's the holy grail of advertising, if you will. Think of what Google does. Think of what Facebook has been doing for so many years. Many of the companies have failed. Many of the companies have tried. And that's what Snap has been trying to do for the last 18 months. And finally, we are seeing some traction in that. That's the most encouraging point from what we learned yesterday.
I think the point you're making here about more evidence before calling it a win for Snap is something the market is seeing as well. You still have shares down fairly meaningfully on the year, Rohit. So what are the hurdles in terms of them being able to actually execute on a fuller turnaround here?
I think at an oversimplified level, I think what Snap needs to do is ensure that user engagement is there. Two of their largest markets, North America and Europe, if you look at what's happened in the number of users in the last 6, maybe 9, or even in US, almost 12 months, they have flatlined. They are much smaller than Instagram. Instagram is growing users, whereas Snap is staying flat as far as users are concerned. And that's a leading indicator of revenues, in my opinion, for social media. So what happens to engagement tomorrow is what happens to users today. And what happens to revenues day after tomorrow is what happens to engagement. So building on that ladder, if users are flat today, it's just going to be very hard for me to have a lot of conviction to say that engagement will rise and hence revenues will rise as well. So that's where the holy grail of social media advertising and monetization is. And if they can grow users in the US and if they can grow users in Europe, I think it becomes a very high conviction story in my opinion.
So still a lot left to prove when it comes to Snap. And I mean, when you take that in context of what the shares are doing right now, currently higher by almost 27%. That is Snap's best day in over 2 years. Is that an overreaction?
I would call it an overreaction. It's kind of a relief rally. I would put it that way. The shares were down almost 40% year to date, maybe 35 and change. And so expectations were going into the print were very low. That was very much unlike, say, a Meta, where expectations going into the print were very high, and the smallest of yellow flags were punished very severely on Meta. On the other hand, Snap, people didn't expect that much, but Snap came in with higher revenues and higher guidance for Q2. So there is a big cheering effect here where you beat the expectations by a small amount, and now suddenly people are paying attention to that. So that's fundamentals are improving, but the expectations mattered a lot on what investors were hoping to see, and that they exceeded by a wide margin. Valuation remains at a premium for this company. There are companies like Pinterest and obviously Meta that are trading at a much bigger discount to Snap, and they're growing at comparable growth rates and even with better profitability. So we prefer those other plays where valuation is cheaper and fundamentals are comparable. So that's how we think about this.
And it's a good point on the psychology, too. Of course, expectations so low going into Snap earnings, so high going into Meta. Let's talk about Pinterest, because it's not just Snap. You also have Pinterest having a great day on the heels of those Snap earnings, currently higher by about 4%. What can we extrapolate out from Snap into Pinterest?
I think what we heard, not just from Snap, but also from Google and Meta, as far as the state of e-commerce and the state of overall advertising, all three companies reported upside to revenues. It's hard to forecast what a company could do from a cost standpoint, but just the state of advertising is strong and has strengthened as the quarter has progressed. That's what we have heard from all three companies so far, and that bodes very well for Pinterest. So almost overnight, the expectations for Pinterest are rising. So we'll need to see if they can now exceed those slightly risen expectations, and that's going to be interesting on Tuesday.
Rohit, what is the TikTok effect here? And when there's so much uncertainty around TikTok, how do we know what the ultimate impact is turning out to be for these other social media companies?
Longer term, as in if TikTok is banned and if they eventually exit US, it's still 12 months out. But if that were to happen, then obviously a lot of social media players will benefit. Even streaming players would benefit. So Meta, Snap, Pinterest will benefit. Perhaps Netflix and YouTube would also benefit, given what would those teenagers do now that they have an extra hour to spend? Probably they'll spend at some other place, and that will drive more revenues. But in the meanwhile, I think if there is volatility inside TikTok, like advertisers start to feel a little bit squeamish about what's happening inside TikTok, some users try to navigate away from TikTok. Probably they go first to Instagram, and next they try out Snapchat. So smallest of such movements of advertisers experimenting on TikTok, stopping those experiments and going over to Snapchat, that definitely helps Snapchat. And that's probably part of the reason why Snap is trading at such a big premium, because there's that TikTok potential halo that could come down the pike maybe in 3, 6, 9 months, even before the door completely closes on TikTok.
Rohit Kulkarni over at Roth Capital Partners, we thank you for your time. Stick with us, everybody. More markets coming up next. This is Bloomberg. It's just about 3:30 in New York, and this is the countdown to the close. I'm Shonali Bassick.
And I'm Katie Greifeld, and we're looking at a big green day in markets, Shonali. A little bit interesting, since if you told me that actually PCE was going to come in hotter than expected on analyzed core, I probably would have thought this would be a down day.
Yeah, and it's interesting because you do see the market for the S&P really jumping back this week, best week you've had, but it does not erase all the gains we saw in the S&P last week.
Very true. Yeah. So let's talk a little bit about sentiment, not just from the investor side, but also the consumer side, because U.S. consumer sentiment slipping in April. This is according to the University of Michigan. The latest read highlighting the toll that stubborn price pressures, along with higher borrowing costs, are taking on consumers. Here with more insight is the woman behind the survey. Her name is Joanne, and she joins us now. She is the University of Michigan Director of Surveys of Consumers. So how much does the fact that you saw consumer sentiment slip a little bit have to do with the fact that inflation expectations are still pretty elevated here?
So overall, I would actually say this slip was very, very small. I would characterize sentiment as being flat, unchanged over the last 3 or 4 months since January. Consumers haven't really seen any dramatic changes in the trajectory of the economy. But at the same time, and one of these things that's not changing is stubborn inflation. Their inflation expectations ticked up just a bit for both the short term and the long term. They're not necessarily expecting inflation to come surging back, but they do feel like this slowdown has stalled.
How do you feel about this kind of stalling of their sentiment? Is there more downside risk here, or a chance that things could start to turn around, and why?
So this flatness of consumer sentiment that we've seen in 2024 followed some surges that we saw at the end of 2023. So what I would say is that what we were seeing in February, March, April, was solidifying the gains that we saw at the end of 2023. So what we are hearing from a lot of consumers is that they're really reserving judgment about the long-term trajectory of the economy pending the results of the election in the fall. So we have a lot of consumers telling us, like, well, my opinion may very well change next week or next month. So I think that there is certainly risk on both sides, upward and downward, but I think it is a good sign that at least the large gains from last year, at the end of last year, remain in place.
Yeah, it's true that, compared to where we were when it came to sentiment about a year ago, especially 2 years ago, things have gotten a bit better. But let's talk about, again, how price pressures sort of filter into that. Because, the frustration a lot of people have is that the rate of inflation is slowing, of course, but the absolute level of prices is much higher than it has been. So, you think about how feelings could change in the next week, the next month, et cetera. Again, how tightly tied is that to price pressures?
Consumers recognize that prices are unlikely to come down. And as a result, consumers continue to be quite frustrated by how high prices really hurts their pocketbooks. We had about 38% of consumers telling us that high prices were eroding their living standards. This is up from 33% last month. So this is something that certainly hurts how consumers feel about the economy. And for a lot of them, at the same time, they recognize that inflation has slowed down dramatically over the last 2 years, that we're not where we were in the middle of 2022 when we were seeing all-time lows in consumer sentiment. So I think there is a recognition that inflation has slowed down, but continued frustration over the pain of high prices.
How do you feel about the differences you're seeing across party lines, given that the election is such an important benchmark here for kind of timing in terms of how people feel about the economy? What's the biggest difference that you're seeing between Democrats and Republicans, and what's driving it?
So what we're seeing when we compare Democrats to Republicans is something that we've seen for many, many years, where consumers who belong to the party that's in the White House tend to have more favorable levels of sentiment than people who don't. We saw that during the Trump administration, during earlier administrations, and we see that now with independents right in the middle. That relationship has not changed. And this overall 4 months, since January of sentiment not really moving a whole lot, that's pretty much something we've seen across party as well. So, we are seeing Democrats with more favorable levels of sentiment than Republicans. Republicans did slip a bit this month, but they're still much higher than they were in the last couple of years.
Can we talk a little bit about geopolitical factors, too? You take a look at the state of the world, and we have 2 hot wars overseas. How is that affecting consumer sentiment at home?
From the looks of our survey, not a whole lot right now. So we continuously track spontaneous mentions of things like geopolitical conflict. And when the Ukraine invasion began last year, there were a lot of concerns about that in the beginning, and a lot of consumers spontaneously telling us that they were concerned about conflict between Russia and Ukraine. In contrast, we have very few people mentioning what's happening in the Middle East. We didn't really have any sort of movement or mention when we, in the developments last week between Iran and Israel. And so this is not something that we're seeing a whole lot of concern about in our survey. This isn't to say that consumers don't care about what's happening in the Middle East, but that it's not something that's rising to the forefront when we're asking them about how they feel about the economy.
Joanne Shu, Director of Consumer Surveys at the University of Michigan, thank you so much for joining us on a day of a fresh report. Now, coming up, shares of Intel sinking the most in almost 4 years, and more on what's fueling the fall. Of course, the biggest decliner here in the Philadelphia Semiconductor Index today, the only decliner really. In today's Stock of the Hour, up next. This is The Close on Bloomberg. It's just about 3:30 in New York, and this is the countdown to the close. I'm Shonali Bassick.
And I'm Katie Greifeld, and we're looking at a big green day in markets, Shonali. A little bit interesting, since if you told me that actually PCE was going to come in hotter than expected on analyzed core, I probably would have thought this would be a down day.
Yeah, and it's interesting because you do see the market for the S&P really jumping back this week, best week you've had, but it does not erase all the gains we saw in the S&P last week.
Very true. Yeah. So let's talk a little bit about sentiment, not just from the investor side, but also the consumer side, because U.S. consumer sentiment slipping in April. This is according to the University of Michigan. The latest read highlighting the toll that stubborn price pressures, along with higher borrowing costs, are taking on consumers. Here with more insight is the woman behind the survey. Her name is Joanne, and she joins us now. She is the University of Michigan Director of Surveys of Consumers. So how much does the fact that you saw consumer sentiment slip a little bit have to do with the fact that inflation expectations are still pretty elevated here?
So overall, I would actually say the slip was very, very small. I would characterize sentiment as being flat, unchanged over the last 3 or 4 months since January. Consumers haven't really seen any dramatic changes in the trajectory of the economy. But at the same time, and one of these things that's not changing is stubborn inflation. Their inflation expectations ticked up just a bit for both the short term and the long term. They're not necessarily expecting inflation to come surging back, but they do feel like this slowdown has stalled.
How do you feel about this kind of stalling of their sentiment? Is there more downside risk here or a chance that things could start to turn around, and why?
So this flatness of consumer sentiment that we've seen in 2024 followed some surges that we saw at the end of 2023. So what I would say is that what we were seeing in February, March, April, was solidifying the gains that we saw at the end of 2023. So what we are hearing from a lot of consumers is that they're really reserving judgment about the long-term trajectory of the economy pending the results of the election in the fall. So we have a lot of consumers telling us, like, well, my opinion may very well change next week or next month. So I think that there is certainly risk on both sides, upward and downward, but I think it is a good sign that at least the large gains from last year, at the end of last year, remain in place.
Yeah, it's true that, compared to where we were when it came to sentiment about a year ago, especially 2 years ago, things have gotten a bit better. But let's talk about, again, how price pressures sort of filter into that, because, the frustration a lot of people have is that the rate of inflation is slowing, of course, but the absolute level of prices is much higher than it has been. So, you think about how feelings could change in the next week, the next month, et cetera. Again, how tightly tied is that to price pressures?
Consumers recognize that prices are unlikely to come down. And as a result, consumers continue to be quite frustrated by how high prices really hurts their pocketbooks. We had about 38% of consumers telling us that high prices were eroding their living standards. This is up from 33% last month. So this is something that certainly hurts how consumers feel about the economy. And for a lot of them, at the same time, they recognize that inflation has slowed down dramatically over the last 2 years, that we're not where we were in the middle of 2022 when we were seeing all-time lows in consumer sentiment. So I think there is a recognition that inflation has slowed down, but continued frustration over the pain of high prices.
How do you feel about the differences you're seeing across party lines, given that the election is such an important benchmark here for kind of timing in terms of how people feel about the economy? What's the biggest difference that you're seeing between Democrats and Republicans, and what's driving it?
So what we're seeing when we compare Democrats to Republicans is something that we've seen for many, many years, where consumers who belong to the party that's in the White House tend to have more favorable levels of sentiment than people who don't. We saw that during the Trump administration, during earlier administrations, and we see that now with independents right in the middle. That relationship has not changed. And this overall 4 months, since January of sentiment not really moving a whole lot, that's pretty much something we've seen across party as well. So, we are seeing Democrats with more favorable levels of sentiment than Republicans. Republicans did slip a bit this month, but they're still much higher than they were in the last couple of years.
Can we talk a little bit about geopolitical factors too? You take a look at the state of the world and we have 2 hot wars overseas. How is that affecting consumer sentiment at home?
From the looks of our survey, not a whole lot right now. So we continuously track spontaneous mentions of things like geopolitical conflict. And when the Ukraine invasion began last year, there were a lot of concerns about that in the beginning, and a lot of consumers spontaneously telling us that they were concerned about conflict between Russia and Ukraine. In contrast, we have very few people mentioning what's happening in the Middle East. We didn't really have any sort of movement or mention when we, in the developments last week between Iran and Israel. And so this is not something that we're seeing a whole lot of concern about in our survey. This isn't to say that consumers don't care about what's happening in the Middle East, but that it's not something that's rising to the forefront when we're asking them about how they feel about the economy.
Joanne Shu, Director of Consumer Surveys at the University of Michigan, thank you so much for joining us on a day of a fresh report. Now, coming up, shares of Intel sinking the most in almost 4 years, and more on what's fueling the fall. Of course, the biggest decliner here in the Philadelphia Semiconductor Index today, the only decliner really. In today's Stock of the Hour, up next. This is The Close on Bloomberg.
Obviously, hey, we delivered a solid Q1, right? We met on revenue, we beat on earnings, a bit tepid in the first half, as we said, but we see a lot of improvement as we go through the year. And with that, obviously, the foundry business, as I would say, we're going to see progress on the foundry business every quarter from now to the end of the decade.
That was Intel CEO Pat Gelsinger weighing in on the chipmaker's latest forecast. Intel is today's Stock of the Hour. There's also some news crossing the terminal here. Apollo, KKR, and Stonepeak may inject billions into a joint venture to help fund Intel's semiconductor fabrication facility in Ireland, sources tell us here at Bloomberg. The joint venture could raise several $1 billion, including debt, the people familiar with the matter say. Abigail Doolittle of Bloomberg Television joins us for more on this. You know, it's interesting to see so many fund managers kind of rise to the occasion. What does this really mean in the story of Intel?
I think it means that they think that they're getting a good deal. That's my first thought, maybe a little bit cynical. But in terms of the fab business, that's the old school part of chips. That's not the leading edge in terms of the AI type chips. Those are the machines that you use to make the chips. So the fact that that's where they're going, it says to me that maybe it's a little bit backwards. Again, I'm not an expert, but my first reading. If you had to take a guess, when do you think Intel's last all-time high was?
I was hoping you would tell me.
I will, but let's take a guess first.
I'll let Shanali go.
Oh boy, years ago?
2000. So this stock has not seen an all-time high in 24 years. So I think that that's a piece of the deal that these companies are getting in some ways, in terms of at least the terms of the deal if they do create the JV. Intel is definitely not on the stronger footing there. Relative to the quarter that they just reported, Pat Gelsinger is correct. It was a decent quarter, but it's the guide that's light. $13 billion, 5% light. A profit of 10 cents is 58% light. So his turnaround's not happening so fast. And again, the foundry business, like I'm not a chip expert, but that seems to me the more archaic version. That's the older school chips. Like you want to be going toward the AI, which they are doing. They are going to be rolling out their new Gaudi chip, which is their AI competitor to NVIDIA. It should bring in $500 million in sales this year. But this story, it's really not working the right way.
No, and I mean, I'm shocked to hear that the last all-time high was in 2000.
It's incredible.
Obviously, shares getting further away from that today. Like you said, it doesn't seem like the turnaround is really materializing, really actually coming to fruition. And that must just be so frustrating to shareholders when you think about how hot the chip industry has been.
Absolutely. And to your point in terms of that frustration, they actually recently started reporting in a different way. They're reporting the foundry business separately and the chip business. But the chip business is also a little light. It's not just the foundry that was weighing. And in addition, I think a big part of the story here, clearly, with that massive miss for earnings for this current quarter, margins of 45.3% in this last quarter. In the current quarter, less than that. They're typically around 60%. So it almost seems as though they've really got to evolve, but it's such a big ship to turn. They've got their work cut out for them.
I do think what's interesting, too, is watching them go to the private markets for money, particularly because the public investors have not been as warm to the stock, as
I think that's such a great point, but it's also a sign. I was talking to somebody recently, today actually, on the private credit side of commercial real estate, and he was talking about how the banking system in general is changing in terms of lending. They're just not lending as much. Now, that's more to real estate, but in general, he was saying that that's the case. And so the idea that you have this capital available from the KKRs, and in this case, the Apollos of the world, that's certainly a trend.
It's a fascinating story. It's going to be fascinating to watch, of course, as Pat Gelsinger tries to turn around. Like you said, there's a lot of wood to chop there. Our thanks, of course, to Abigail Doolittle. And that is a great point that, the public markets maybe getting a little bit frustrated here. Maybe it's the private investors who really step up to the plate.
Yeah, it's interesting. At least in the case of Intel, you saw them really pair up with Brookfield years ago as well for a separate manufacturing expansion, this time in Arizona, of course. Now, this time around, we're talking about Ireland. But Intel's still down more than 30% on the year here. So frustrating, as you can imagine, with the AI boom here for investors.
Absolutely. Down 30% for the year, 9% on the day. Coming up, we're going to count you down to the closing bells. We're going to do that with Steve Sosnick. He is chief strategist over at Interactive Brokers. Really looking forward to that conversation. This is The Close on Bloomberg.
This is the countdown to the close. I'm Shonali Bassick alongside Katie Greifeld. What are you watching, Katie?
I'm just watching the markets because it is so remarkably such a big day in markets. You take a look at the S&P 500, currently up about 1%. I mean, all of a sudden, the best week of the year for the S&P 500 really feels like it came out of nowhere. And you think about how bad we felt after Meta earnings, and here we are, just a remarkable turnaround.
Just that two-year yield, shocking. That bid really disappearing. We are at 4.999 on that two-year yield. It would really like to touch 5%. We're going to talk more about this market. We're going to welcome Steve Sosnick, chief strategist over at Interactive Brokers. 4.999. I'm laughing a little bit because what does 5% mean, right? Can it go higher than that? And that would imply, it seems, not only prolonged delays here in rate cuts, but something else going on with inflation.
Clearly, Sonali, I think what we're seeing here is, and I'm starting to get whiffs of stagflation, dare I say it. I know that's like a dirty word in a lot of circles, but
probably necessary to talk about right now.
It kind of is, right? We ended up with a GDP print that was far worse than expected, 1.6 when we were looking for 2.5 versus 3.4. That's terrible. And you had a worse PCE number yesterday, which of course is not the PCE number, but a PCE number. Well, if you have a weak economy and inflation that's not coming down, you kind of have to think in those terms, and that's why it was kind of shocking to see bond yields rise on a day where GDP was a big miss. So it has to be that other inflation nervousness.
So is now a time for caution? I mean, how should I feel right now, Steve? I look at all this economic data. It seems to just say that basically inflation is still sticky. It's still high. Stocks are rallying. Yields are, doing what yields are doing. How should I feel?
You should feel concerned a little bit. I think the time for just closing your eyes and buying anything is done. I think that ended sort of on March 31st, or maybe call it April 15th, just around tax day, when people actually who made a lot of money in 2023 took some profits, which is why you saw Nvidia and some of these other stocks pull back. But I think right now you have to start to wonder, the push-pull between stocks and bonds is getting a little nerve-wracking. I think we were able to ignore it for most of the year so far, partly because of just the weaponized FOMO that was in the stock market, buy anything, partly also because of the reason that yields were going up, which is a stronger economy. And on balance, stocks do like a stronger economy up to a point. The bond market starts to freak out a little bit, and we've gone from sort of the bond market just sort of rising because the economy's getting better to now the bond market starting to get a little stressed.
How do you feel about some of the complacency in other parts of the bond market? You think about where people have really placed their money earlier this year in pretty risky wagers, frankly, assuming that there's really almost no rollover in maturities here.
It's actually quite astounding how many of the strategies that worked really well in the, let's say the 2020 to 2021 period, the money flowing everywhere strategies are still being employed now, and yet they're still working. That's one of those things.
When do they stop working? I think
that's the problem. That's my point to Katie, is maybe we need to start getting a little more concerned about some of these things that are underlying it, because the spigot is not on full blast anymore. It's not turned off, but I think some of these, we're still hunting yield incrementally. We're still hunting excess returns, and they should be getting harder to come by. Fortunately, so far they're not, but that gets the nervousness in.
Isn't it funny that people still have that yield-seeking behavior? They're funding into, of course, risky parts of the bond market. When you take a look at cash right now, earning 5%. Actually, Bill Gross, he tweeted the other day, why bother with bonds? T-bills are at 5.25%. Seems like a slam dunk there.
You're speaking to someone who has too much money in money markets by a lot of people's point of view. But yeah, it's the same basic thing. Think about it this way. We went up 10% in the first quarter, S&P, which was fabulous. Can you annualize that? Are we going to be up 40% this year? I'm going to say no. So at some point you get the back and the fill, and when you're getting that back and fill, when you're getting some of the volatility, it's not the wrong place to be if you can actually earn a real rate of return on cash. It's something generations of investors have just not been used to. And I think we forget about that sometimes. Bill Gross, having the perspective that he does, says, okay, there's nothing wrong with just, parking your money if you can make some profit on it.
This whole idea of where's the risk, we were talking about some of the steam coming out of some of the favorite trades, but the question is, how much drawdown risk is there still, especially going into a big Fed meeting, a big payrolls print, and potentially a new economic environment?
I think the drawdown risk can be substantial in terms of we didn't complete a correction. It felt like we corrected, but we really were down, call it 4 to 5%. Certain stocks had big corrections, but as a market as a whole, we didn't really complete that correction. It's possible. I'm not necessarily saying that's the base case. There still seems to be this underlying residual momentum in earnings season. We've gotten our requisite 80% of stocks beating estimates, so that seems okay. But that would sort of be my point. It's to say this is not out of the question, because it's really finishing the correction is really down another, call it 5 to 6% at this point, which is not historically unusual.
And you really know it's been a crazy week, because I actually had to check as to when Tesla reported, and turns out it was 3 days ago. Can we talk about some single names here? Can we talk about Tesla a little bit? You write in your notes that finally maybe we're starting to see some genuine risk aversion priced into Tesla shares. I mean, what do you make of what we heard, of course, on the call?
It just shows you what a wacko stock Tesla is, and how faithful. I've called it a faith-based stock for years. And any other company, if it put out numbers like Tesla did, would have been shredded. I don't even want to put a number on it, but it would certainly double-digit down. But Tesla investors are always looking to the future, and so, let's talk about robo-taxis. Let's talk about a $25,000 car that may or may not actually be coming to market. But if you put enough futurism in front of the Tesla investors, that is what gets them going. The reason the stock rallied also was because for the first time in ages going into earnings, we actually saw the options market pricing in some real risk. And what we learned this week was the option market was a good contrarian indicator. It it was showing a lot of risk for Tesla. Tesla went up. It was showing not too much risk for Meta. Meta went down. It then, because of Meta, it was then pricing in a lot of risk for Alphabet and for Microsoft, and they were fine, right?
Well, it just is another indication of a lot of investors here running for some cover. Steve Sosnick, is Chief Strategist over at Interactive Brokers. We thank you so much for speaking to us into the closing bell. We have had a heck of a week, Katie.
It's been a heck of a week. Tomorrow, next week promises to be a heck of a week as well. Of course, we're taking a look at the best week for the S&P 500 all year, and Tesla shares up 15% this week, despite, of course, what the numbers said, but what Elon Musk said was obviously the winner.
I do wonder what the market narrative is, though. Without all the earnings that we have seen this week, certainly it should shift back to the Fed. Now we're moving closer to the closing bell here in the United States. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Now about 2 minutes away from the end of the trading day, Sonali Basak and Katie Greifeld taking you down to the closing bell. And here to help us take us beyond the bell with a global simulcast, we're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Carol, my goodness, I have a whiplash today.
Yeah, pretty interesting, right? And even the week overall, when you look at the numbers, we'll get to that in just a moment. I know Tim's on that, but I'm looking at the Philadelphia Semiconductor Index. The SOX is up about 2.5%, and that's despite a mega sell-off in Intel, KLA 10 Core, or KLA Corp, I should say. They had some results that beat. That maybe helped lift the sector overall. NVIDIA is rallying in today's session because of all the AI enthusiasm. So it's interesting when you start to dig a little deeper into the market, you see some differences.
Okay, well, Carol mentioned the positive week that we're having. For the Dow Jones, it's actually the laggard of the week, only up 0.7% over the last 5 days. The S&P 500 up 2.7% over the last 5 days. The tech-heavy NASDAQ composite up by 4.3% over the last 5 days. Kind of all thanks to yesterday, I think, and today.
Now, it's interesting, too, because even with that Intel feeling here that is weighing down that stocks a little bit, the idea here that we've bounced back so drastically and you're seeing the semis get more love than the NASDAQ or the S&P is just an indicator of how much this AI boom is driving this market, isn't it?
Yeah, absolutely. I know that people are a little bit freaked out about what we saw with Meta. Of course, the year of efficiency over, but then you had Microsoft, you had Alphabet coming out with some big AI sort of spend and also some things to show, and that really revived this market.
And there are the closing bells. What a week. Friday is here, and the NASDAQ up more than 2% to close out the day. And you have, remember, those tech-heavy stocks really driving all the indices here. The S&P 500 still ending the day up 1%, ending the week, the best week of the year. And the Dow Jones Industrial Average up about 0.4%. A lot of green on that screen.
Yeah, for the week overall, as we said, S&P up about 2.6%. The NASDAQ up about 4.25%, and the Dow Jones Industrial Average just about 0.2%. But yeah, definitely a much more risk-on tone this week, Katie.
Meanwhile, you take a look at the sector level, and it's pretty much an even split, interestingly enough. You take a look at what is working today, and it's communication services in a big way. That sector up about 4.7%. Then there's a big drop-off there. Information technology, still a big rally, up about 1.9%. Consumer discretionary and materials also having a good day as well. You take a look at what didn't really work today, and it was utilities. I mean, this was a big risk-on day. Utilities, of course, on the heels of that, down about 1.1%, and energy also off by about 1%, Carol.
All right, let's get to some of the individual gainers, guys. You know where I'm going to go. It's Google, Alphabet. That stock up just shy of 10% in today's session. I'm looking at the S&P 500. It's your two and three gainers. So top gainers in the S&P 500, number one gainer in the NASDAQ 100. As we know the story, right? Leaping into the $2 trillion market cap club because of the move up in today's session. Revenue beating on strength of its cloud computing unit, cloud demand fueled by growth in AI, and introducing a dividend and a $70 billion buyback program. So taking a page out of Apple's book and a few others. Not Apple's, I should say Meta, right? Or Apple. I guess they're all
We'll find out.
What did Mandeep say that now is it 6 of the Mag 7, right? Or
yeah,
5?
Are doing dividends.
Are now doing dividends. So now we got Alphabet playing catch up. Microsoft, of course, an outperformer in today's session. A gain of just shy of 2%, finishing off its highs of this session. Sales profit beat. Again, sales of its Azure cloud computing platform climbing 31% in the quarter. That was a beat. About 7% of that increase was attributable to AI, compared with about 6% in the previous quarter. So that's growing. And then one more AI-related name. Every time there's some enthusiasm around AI, NVIDIA wins, up about 6.2% in today's session. Number 3 gainer in the NASDAQ 100, rallying back from last week's sell-off. Some of the chips giants' biggest clients doubling down on AI. Stock is up roughly, I think, around 15% this week, so it added a lot to its market value. We know, again, whether it was Alphabet, whether it was Microsoft talking AI, it really helped out this name, which is up almost 80% so far in 2024, Tim.
Okay, you got the gainers, Carol. I got the decliners. Not that easy on a day like today, but I do want to start with shares of Intel. Got to go there. Tumbling the most in almost 4 years intraday today after it gave a lackluster forecast for the current period. It indicates that it's still struggling to return to the top tier of the chip industry. Shares finishing the day down by 9.2%. It did close off lows, but at one point it was down. It closed off the lows, so closed down the worst since January, but at one point the worst in almost 4 years. The outlook does signal that the push by Pat Gelsinger to revitalize is going to take more time and money. Also, shares of ExxonMobil plunging the most in more than 6 months. This after higher than expected maintenance costs diminish its oil refining results. Shares falling today, marking the oil giant's worst intraday decline since it announced that $60 billion takeover of Pioneer Natural Resources. That was back in October. As for what caused this, we saw various mostly non-cash accounting items behind the rare earnings miss, posted an adjusted earnings per share profit that was 13 cents below what analysts had forecasted. And then ticker TEAM, team for Atlassian. It's the maker of Jira, Confluence, Trello. Fell after the co-CEO, Scott Farquhar, announced that he's stepping down from the company that he helped start more than 2 decades ago. It was a surprise move, and it certainly rattled investors. We actually saw the company report earnings yesterday, and they reported pretty good fiscal third quarter results. Revenue $1.19 billion, above the average analyst estimate. Profit, excluding some items, was 89 cents per share. That beat the 62 cents per share projected by analysts. Still, the company added customers more slowly than anticipated. The co-CEO is stepping down. Farquhar plans to spend more time with his young family, improve the world via philanthropy, and help further the tech industry globally. That's according to the statement that we got yesterday.
Let's talk about the bond market now, because of course there were a lot of interesting moves there. You saw the 2-year, of course, kind of be flat on the day, but remember, you're looking at a 4.99, just under 5% on the 2-year. That has drifted about 2 basis points higher on the week, just ahead of that Fed meeting next week. And the 10-year yield, interestingly enough, a bigger move, closer to 6 basis points moved higher on the week, which gives you a yield curve even more deeply inverted here. I know a lot of people are not talking about that anymore, but I'm certainly still watching it, and you do have a little bit of movement here. Yields a little higher, about 3 basis points along the longer ends of the curve. Even if you didn't see the 2-year move that much, the levels you're seeing here are pretty stunning.
Well, we're all going to be watching the U.S. yield curve next week as we get ready for another Fed meeting. That, of course, that decision on Wednesday. Then you've got a jobs report on Friday. But on this Friday, this is what we're focusing on, because Goldman basically has a message for its bankers. You're looking to go to Paris. You got an important meeting between July 24th and August 14th. Gotta go. We're on to you.
Okay, here's what they said in a message, and a spokesperson for the bank said, quote, "In line with previous Olympic Games, we've asked our people to effectively manage their spend and ensure coordination with firm-sponsored events for our clients during the period of the Paris Games." Oftentimes, events like this could be settings for employees to meet with clients, but they also throw opportunities for staff angling for junkets, which banks attuned to keeping a lid on costs.
Nobody's ever done that. Wait, I gotta go. There's something important, an important meeting.
U.S. Open, anyone?
Yeah. Oh, wait.
Yeah, people like to go to that.
That's work.
I mean, you can't blame them for trying. It makes a lot of sense. And I don't know, it makes sense, though, too, why Goldman would want to keep a lid on costs. I actually am going to Paris for the Olympics, and it's going to be a lot.
What are you
going to
watch? I'm guessing you're going to watch track and field.
That's all I'm going to.
But it's not like you said to your editors, "Hey, there's this story I've got to do. I've got to do it in Paris, and it's between this time frame." That's not what happened.
A few people in this building have asked me if I'm going for Bloomberg, and sadly, the answer is no. I'm just going as a regular old person.
No, that's a good thing.
Paying my way.
Well, you're better off that way, I've got to say. You want to enjoy it while you're there. Not
That's
have to
true. I will
feign
enjoy it.
that you were looking at your emails. You can just be gone, Katie, and we'll enjoy it for you, too. I want to talk about something else. For those who are sticking around that week to be working here, is like there are very expensive coffee makers out there. If you haven't seen it, guys, Whirlpool is actually now looking to diversify even more and sell $2,000 espresso maker. They're betting that those who are spending a little bit too much money at those high-end coffee shops or even at Starbucks will instead take that $5 and camp it in the bank of buying their new automatic espresso maker.
Hey, listen, it's like a little luxury. And, if you're going to do that, you might want to actually put some decaf coffee in there. Everybody makes fun of decaf coffee.
Yeah.
But Pursuits, our Bloomberg Pursuits team, saying it's becoming the hottest thing in coffee right now. And there's actually a U.S. Brewers Cup, a competition. And for the first time in the competition's 20-year history, a decaf coffee took the title, so don't make fun of it. But one thing you might want to make fun of is Tim, because you got to ask him about his coffee machine.
Hey, anytime, I'm a big coffee guy at home. Anytime anyone wants an espresso, you're welcome to swing by.
It's a really nice machine, we hear.
Is it decaf?
We don't use decaf beans in our
Very
house.
good.
There's no
Carol, I'm
point.
going to keep making fun of decaf. What is the point of decaf coffee, truly?
I got through, it's really sad, college on decaf coffee. And what is it, the instant coffee. It was
instant
really
coffee.
I know.
That actually tastes pretty good. It's a weird one, but it does.
All right, guys.
There's a lot of controversy.
We're going to need a lot of coffee next week between earnings, the Fed, and, of course, jobs. So we're going to call it a wrap. Have a good and safe weekend, everybody. We'll see you again. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We'll see you again on Monday.
And coming up, we're going to wrap up the insights from this week's tech earnings results and push to what's expected next week with Sarah Hunt, Chief Market Strategist over at Alpine Saxon Woods. Stick with us. That conversation's coming up. This is The Close on Bloomberg.
All right, welcome back to The Close. I'm Katie Greifeld.
And I'm Shonali Basak. We're going to take a look at where the markets closed out the day because we finally have some green on the screen.
Finally.
I feel like you're in the mood for that today, Katie. So we were waiting for that green. The S&P 500 ended the day 1% higher and more love in those tech stocks. We had the NASDAQ 100 more than 1.6% higher and the semiconductor index, Philadelphia Semiconductor Index, 2.6% higher. That is shaking off all those losses, of course, you saw in Intel, which was the only stock down in that index on the day. The two-year yield flat on the day, but more than 2 basis points higher on the week. A lot of economic data just under that 5% level, Katie.
And the green continues. Let's talk about some of the day's biggest movers. And I went with a sort of social media theme here because we have to talk about Snap and the day that was. Snap shares finishing the day nearly 28% higher. That is the biggest rally in over 2 years, of course. Coming out with details of their ad revamp really seems like it's finding its audience. And clearly, people said that's probably good news for Pinterest. Maybe we should have some hope there because Pinterest shares also closed higher by about 4%. And then I also wanted to put up Meta because we remember those earnings results that we got earlier this week really didn't go as well as people had expected. Of course, expectations were very high. Meta share is going to finish the day about 0.4% higher. And that brings us to our top story this hour, and that is the rally in tech stocks. It's really helping push equities towards their best week this year. We did officially close there, and you have Microsoft and Alphabet sending a clear message to investors, and that's that spending on AI and cloud computing is finally starting to pay off, Shonali.
And for a deeper look at those results from this week, we're joined by Bloomberg's Abigail Doolittle, who has been keeping a track on everything that's been going on.
Yeah, it's been quite a week. goodness, it's Friday, is all I can say. TGIF, I can't even get the letters with the words out of my mouth. Overall, I would say that there's relief that the tech earnings have skewed better. Certainly in terms of Tesla starting off the week, the quarter that they reported was awful, but Elon Musk not throwing in the towel, putting, some real big talk in around the cheap car that it will be here by early 2025 or even by the end of this year. So basically, a possible revamp of growth for Tesla. You nailed it, Katie, in terms of Alphabet and Microsoft, all about the AI and the cloud spending. For both of these companies, for Alphabet, 28% cloud growth, 32% for Microsoft, so better. Meta, though, not so much. I would argue that both of those companies, Alphabet and Microsoft, helped out by Meta's disappointment because it was such a mess. And the quarter that Meta reported, it was a good quarter, but I think everybody's reminded of not the year of efficiency, but the metaverse year when it was a total disaster. And the idea that maybe they're just going to be, crazy spending on AI. AI seems to be different than the metaverse, which I don't even know what that ever was. When that was announced, I couldn't believe that they gave up the best marketing name, Facebook, ever. I'm not even on Facebook, but it's clearly one of the best trademarks out there for Meta and the metaverse. So I think people just are reminded of that misstep back then. And could it go longer and further? Plus, they're giving up growth on the top line. So that's not good.
And so let's push this conversation ahead, too, because we're still in the heart of tech earnings. We have some of the biggies next week, including Amazon. What are we expecting there?
Amazon, it'll be very similar to Alphabet and Microsoft. The pressure's on them to put up now results around the cloud, their cloud business, that AWS, and what will the AI drive be there. Now, could there be a disappointment? Because there had been some expectation, especially for Alphabet and Microsoft. There was one analyst who said it's all about surviving and advancing. Now, they clearly both are thriving, but could it be different for Amazon and those two business lines? And then Apple down 12% since I think it's on the year. So in a correction, single digit growth there. What are they going to do? That's going to be key. Demand for iPhones.
All right, Bloomberg's Abigail Doolittle, thank you so much. And staying in the tech world, we do have some breaking news, and that is that Eric Anderson, he is general counsel for TikTok and its parent company ByteDance, today announced that he will be stepping down from his role in June, and he will then take on the role of special counsel to the company. Taking a look at the press release right now, he's going to focus on helping to drive the company's effort to overturn the unconstitutional ban, their words, that legislation in the U.S. and other pressing legal matters. Of course, we're going to continue to follow that story and how it develops. But let's turn now to the tech earnings, of course, the week that was and the week that still is to come. We're going to do that with Sarah Hunt. She is partner and chief market strategist over at Alpine Saxon Wood. Sarah, it's great to see you on set.
Oh, thank you. I love being here.
So let's talk about big tech. It seems like when it comes to spending and CapEx that investors really like what that brings. But as we learned in the case of Meta, just the sort of the price tag on what it actually takes to get there maybe is spooking people.
I think it's a combination of the price tag and what they're spending it on, right? If you say that you're spending it on what has clearly been demonstrated by both Microsoft and Alphabet, the AI that is driving better sales, better revenue, then people are very happy. If you say that you're spending it on things that people are still worried about, which is, I think, the problem that Meta's having, which goes back to you're spending too much money on the metaverse and therefore giving up other things when we thought that you had given that up. I think that that was the differential there. But also, Alphabet's main business was doing quite well, and people were much more worried about ad search, and it actually search came out quite well.
I think when you look at the results this week that you saw kind of shrugging off Meta's kind of discontent here in the market, if you will, how do you feel about the gains moving forward? Do you think that the exuberance that we saw this week, particularly around Microsoft, Google, will last?
Well, I think, it was down to Microsoft and Google to do well this week because I think it really drove and sort of dealt with some of the upset that we had the other day. And I think that going forward, if they can continue to demonstrate those better growth rates because of the investments that they're making and because the driver of AI is so strong, then I think that you can have some real legs to some of this on the equity market story. This was the big question last year. Are these earnings going to come through? And if they do, are they going to be good enough for people to say, okay, I can hang my hat on better S&P earnings next year because of the tech sector? And right now, they did a lot to forward that.
And it's so interesting. There was so much resting on the shoulders of Microsoft, of Alphabet, and it was really a show me story, and they were able to do it. But then you think about that in the context of Tesla, that was not a show me story. That was okay, things were really bad, but take a look at the future sort of story. And it's interesting to me that worked.
Well, I think it only works if you're Tesla. I don't think anybody else can quite get away with that the way that Elon Musk can get away with that. And I think that that's one of those situations where at some point something's going to, those cars are going to have to come out because he's already taken prices down on the higher price models. So he's going to have to demonstrate that you can make money on the lower price models and or have another iteration of something that gets people excited. But there's very few companies that can get away with putting up those kind of numbers and having the stock react in a positive way.
Set us up for next week for Amazon. You know, Katie pointed out that unlike the other big tech companies, a dividend is not in play yet for Amazon. Do investors want to see this, and would Amazon hand them such a victory?
You know, it's interesting because the fact that you're seeing both dividends and buybacks out of some of the Mag 7 or Mag 6 or whatever we want to call them right now tells you that the cash generation is extraordinary and they expect that to continue. I think Amazon is at a point where they have done a lot of spending so that they could start harvesting. Whether or not they're going to put the dividend on this quarter or any quarter, it really depends on whether or not they take it in that direction. But I think it just demonstrates the immense cash generation that we're seeing, and I think that that's what investors like to see.
I love the dividend story in big tech because it feels like a contradiction. Like we're talking about some of the biggest growth companies out there that are so mature, they have so much cash that what else are they going to do with it? And I think, I don't know, when I think about it, it sort of speaks to this all-weatherness sort of vibe that some of these big tech stocks have, that basically they can fit in any bucket you want to put them in.
Well, and the fact that they can say, look, I'm spending all this money on CapEx, but I also have enough money to buy back some stock and give you a dividend. Again, the discussion has always been about the massive generation of cash. I mean, even Apple, which has had a tough time recently with some of the issues that are going on with China and refreshing the iPhone, there's still an enormous amount of cash that these companies generate. And that makes a big difference going forward for investors. And when people start to talk about walking away from tech, you can't really walk away from that kind of cash generation and that kind of growth. And what you're seeing demonstrated right now is that that growth can continue and it can ramp itself up in ways that people weren't quite expecting. And I think that that really saved equity markets, at least for this week and going into this quarter. It really helped earnings season out a lot.
Sarah Hunt of Alpine Woods Capital Investors, we thank you so much for taking a look at all that happened in tech this week and all that's still about to come. Now, coming up next, we're going to talk about the top three. We're going to focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. Stick with us. This is The Close on Bloomberg.
Wednesday, the Fed decides.
Jake Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
It's time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. And up first is Bob Bakish. According to the Wall Street Journal, Paramount is considering removing him as CEO and installing an interim committee of top executives to run the entertainment giant. Of course, we know, Katie, this comes in the middle of a massive question on who's going to own Paramount
exactly.
ahead.
Yeah, I was excited and interested and confused, honestly, seeing this headline, because I was like, this sale process is already so thorny, and it just got a lot more complicated potentially.
Yeah, it sure did. And you have to wonder also what David Allison's own plans would be if he were to own it.
A lot of big questions still, of course, when it comes to Paramount. But let's also talk about Jeff Bezos, because the FTC is accusing him and other executives at Amazon of destroying text messages discussing business, erasing evidence the agency could have used in its antitrust case. I mean, you think about how aggressive this FTC is, and also all these high-profile instances of people really across industries getting in trouble when it comes to text messages, etc. Now we have them combined into one.
Yeah, it's interesting. It was from April 2019 to May 2022, and it was signal messages. And of course, it's interesting to see the way people change the way they use these platforms. Of course, even in recent days, I've had executives say, text only, please, no WhatsApp, no Signal. We don't do it anymore.
How about meet me on the corner and we're going to talk in person, because I don't trust anything.
What is it? Payphone.
Yeah, exactly.
Now, also another person I'm watching, Howard Lutnick. I spoke with the Cantor Fitzgerald CEO about when he's expecting the Fed to cut rates. Take a listen.
think right before the election. Not that the Fed is involved in elections, but September? I'm thinking September, and it's not really to move the economy. It's to show off a little bit, help a little bit. You know, the guy who's employing you today, maybe he'll give you your job again if he gets elected. Can't hurt. So I think September, one cut. That's it, just showing off.
I mean, he goes, I'm not saying the Fed is involved in elections. You know, it's funny. Lutnick also talked a lot about the elections and the impact it has on the market. Remember, he was also one of the people that threw that $50 million fundraiser for Donald Trump down in Palm Beach. And he was talking a little about what people are watching into the elections, regulation, immigration. Although, Katie, he did say that you can't say Joe Biden was bad for the market.
Exactly. I mean, you take a look at the S&P 500's performance under Joe Biden. I don't know. I feel like it just goes to show when you think about how, because the stock market also did well over Donald Trump, does it really matter who's in the Oval Office? But I know that Howard Lutnick made the point to you that the Republican Party, less regulation, that's seen as more business friendly. So that would translate theoretically into stock.
The whole FTC non-compete thing was this week, and of course that would impact Wall Street disproportionately given the pay packages you see on Wall
Also,
Street.
the Biden administration's proposal on capital gains taxes. What was the rate proposed, like 44.6%? That would be extremely aggressive, and I could see why a lot of people on Wall Street would not like that.
You can't tell what's going to make it to see the light of day. As a journalist, it gets quite frustrating talking about what you don't know will actually happen or not.
Yeah, just got to stay tuned.
We got to stay tuned. And of course, I got a lot of messages after that newsletter went out about all those people moving to Florida and not paying those taxes anyways. Now, still ahead, we're going to shift from taxes and the government to artificial intelligence. We're going to use that conversation to talk about consumer preferences. Promise you, there's a link. We're going to talk to Alex Elias, co-founder and CEO of Qloo. This is The Close on Bloomberg. Stick with us.
It's time now for Next Up, where we highlight the entrepreneurs and founders moving the needle in our economy, in markets, and in technology. And businesses looking to capitalize off of consumer trends are turning to companies like Qloo for their data. It's an application programming interface that uses its catalog to help companies predict and dissect consumer preferences. It's used by the likes of Netflix for what movies users want to stream for date night, or it can tell Universal Music Group if people do chores listening to Mozart or to Taylor Swift. Joining us now is Alex Elias, co-founder and CEO of Qloo. And Alex, let's start with a basic question, which is, where do you get the data to make these inferences from?
Absolutely, and so great to be with you. I remember being here in 2017, espousing the virtues of AI, privacy, well ahead of GDPR and all the regulatory environment, and it's so exciting to see these trends materialize. I think that segment was predicting consumer tastes with cultural AI. And here we are in this new landscape where privacy is paramount, AI is everything. And Qloo is one of the companies. We've been in the market for over a decade. We've been squarely focused on the premise of generating inferences in a way that's totally ethical, but can span across the globe and across all categories of media and entertainment. And so part of how we do this is we built this unprecedented database of cultural entities. So think about every restaurant around the world, every movie that's been distributed in the US, Europe, even Bollywood. And we look to understand the underlying characteristics of those places, those things. And then we built best-in-class recommendation engines that parallel sort of what you get from your favorite consumer services. So if you think about Spotify within the world of music or Netflix within the world of film and TV, they've of course come around and become a customer. What we do is we generate these predictions based on the actual characteristics of the entities and can do this at global scale. And it's a very exciting time.
So can you give us an example of that, one of these inferences that, of course, that you've made?
Yeah, absolutely. So Qloo owns a company, for instance, called Taste Dive. Taste Dive has millions of users. It's a great platform to get suggestions based on your taste in any area. And something Qloo really excels at is you can give it a sparse amount of information. So you could tell it a favorite movie, a favorite restaurant, and it'll be able to generate predictions across all different categories of culture and entertainment. And that's something that customers have really come to rely on us for in terms of generating really ethical, sound predictions about taste.
What are the strangest taste experiences that you really found, the insights that you found that perhaps would be surprising to your clients who are gathering these insights and trying to figure out how to meet the consumer?
Yeah, I mean, one of the most interesting things is that there's strong predictive ties in unexpected areas. So sometimes your taste in music might be one of the best ways to suggest a restaurant in a new town you're visiting. And you see that with some of the main recommendation engines sometimes struggle when they just know one category of taste. And so we've been doing a lot of work recently with various clients. You look at some of the largest ticket marketplaces, for instance. You have a situation where you're syndicating and selling 500 million ticket sales a month, and you need to make very accurate predictions with very little information. People only tend to buy tickets, once or twice a year. So how do you take just one little piece of information, say a favorite music artist or a favorite comedian, and then generate recommendations across categories like sports and comedy? That's something Qloo truly excels at. We're able to handle network requests of up to 3 billion requests per day in certain integrations. So it's a really exciting time, and something we've really seen in the AI landscape is that language models are becoming all the craze. And when I last spoke with Bloomberg in 2017, these were nascent technologies that have now really taken fore. And so something that Qloo excels at is imbuing language models with a source of truth and accuracy. And a lot of our greatest integrations now we're seeing are actually leveraging language, which is kind of the new interface over data. And so what Qloo can do is basically help guide those systems. So if you wanted to have much more accurate trip planning, for instance, and itinerary generation, that's some of the unique use cases that Qloo offers.
What about generative AI is different today than it was a few years ago? If you think about the way your company's evolved, why is it able to move in different directions now than perhaps before?
Yeah, so when you think about language models now, it's one of the greatest interfaces over data, but you still need great data. And so part of our contribution to this space is the ability to imbue those systems with a source of truth to reduce some of the hallucinatory tendencies that we've seen in these language models, but also guide it towards an outcome that actually has material business KPIs. So if you're a business that's trying to sell more goods, you're trying to understand consumers better, Qloo can play a role in that loop. And part of the issue we have today and many businesses face today, and this is even more true than it was when we last spoke with the network, is that consumer tastes are so fragmented. There's so many interesting new music artists, restaurants, travel, they're becoming more heterogeneous and interesting. And so having something that at scale can generate ethical predictions about our taste and make applications smarter while respecting the existing privacy regulations, but also all the forthcoming AI regulations that'll become more and more material. That's something that Qloo is really focused on, and we're super excited to be working with the likes of Netflix and Michelin and JCDecaux, which is the largest outdoor billboard company, helping to power what ad gets shown where, depending on context. So yeah, it's a very, very exciting time. We've been ahead of the curve on a lot of these themes, and Qloo has built its databases, its intelligence well over a decade now.
Elias, co-founder and CEO of Qloo, we thank you so much for keeping an eye around the corner in artificial intelligence. Now, I want to give you a check on where the markets have been, because a look at the Japanese yen before we go to break, just breaking 158 against the dollar. Incredible, Katie, when you think about how even just before the Bank of Japan's meeting, that yen traders actually boosted their shorts against the yen to record highs ahead of that meeting. And now we are just seeing the yen weaken further higher on the day heading into the weekend. And after that Bank of Japan meeting, back when we were at 155 earlier in the week, we were thinking those were potentially leading to intervention levels. And you have to wonder what happens as we see the pace of this weakening just accelerate. We will be back to you with more on the markets next. This is The Close on Bloomberg. Now, President Biden says he intends to debate Donald Trump ahead of their November general election rematch. He spoke earlier today in a wide-ranging interview with radio host Howard Stern. And for more, we're joined by co-host of Bloomberg's Balance of Power, Joe Mathieu. What happened in this Howard Stern interview, and how did it even come about, to be honest, Joe?
Well, it's actually that the latter question is, for me, a little bit more interesting because the jury's really out on whether we're going to see debates between these two, and we can talk about that more. The fact is they haven't even had a meeting on setting rules that you would typically have underway at this point. But the fact that the Biden campaign is putting the president of the United States on with Howard Stern for over an hour without a break, without a bleep, says a lot about where they want to position him and the people they're trying to reach right now, with polls showing, including our own at Bloomberg, a real disconnect when it comes to issues like the economy. They want him to be speaking to regular people outside of the political cable news sphere and show kind of his natural side, maybe act like he can keep up a little bit, appeal to some younger people. Most of this was biographical. He talked about where he met his wife growing up and getting into politics and so forth. And that's the kind of stuff they want, as opposed to, a confrontational one-on-one interview with a reporter. It does a lot more for the campaign.
Well, the without breaks part is really impressive, I have to say, as someone who does a lot of live television
you
and
understand.
radio. Yeah, without breaks, that is quite the undertaking, though. But to the point that, they're trying to appeal to that younger audience, I mean, is it going to work? Are the young people listening to Howard Stern?
Well, listen, that's a very fair question. And, for full disclosure, I used to work there myself. Look, whether he's reaching young people, I think it's about getting him off the script. It's about getting him talking about himself instead of controversial policy. And I'll remind everybody that Howard Stern helped to make a celebrity out of Donald Trump. He used to be on that program all the time, certainly back through the Apprentice years, and there's a lot of tape that Donald Trump would probably prefer not be played at this point from his conversations past. And Howard Stern's had a bit of an evolution. He's grown up some. His politics are more in line with Joe Biden. So there are a couple of things at work here in the campaign deciding to do that. It was essentially unannounced. He's up in New York for other matters, and he stopped by the studio for this interview. So it's kind of an interesting turn for them. He's going to be making jokes tomorrow night at the White House Correspondents' Dinner. So maybe that was the warm-up.
Well, I certainly hope that you are attending and you'll get some free chicken out of that. Our thanks to Joe Mathieu. And of course, you can...
Rubber chicken.
Rubber chicken. Sounds delicious. You can catch Joe and Kaylee Lyons coming up at the start of the next hour, of course, on Balance of Power. Meanwhile, you have Trump's allies quietly drawing up plans to erode the Federal Reserve's independence if Trump wins a second term. That is according to reporting from the Wall Street Journal. Sources familiar, but the group is arguing reportedly that Trump should be consulted on interest rate decisions. Joining us now with his perspective is Andrew Levin. He is Dartmouth Professor of Economics. And needless to say, Professor, I mean, if this happened, it would certainly break precedent.
Well, so the first thing to say is that whenever I read a story with no attributions at all, I get a little bit uneasy. And in this case, there were several indications that the kind of brainstorming that may have happened was among former advisors, referred to them as allies. But on the other hand, the story specifically stated that the senior economic advisors to former President Trump didn't know anything about this. So this kind of brainstorming happens all the time. I'm not sure what to make of it, honestly. But the Wall Street Journal did decide to publish it, and so they evidently, putting their name behind it. That said, I think that there were three important distinct pieces of the report. One was on regulatory policy, one was on the emergency credit facilities, and the third was really the third rail, which is monetary policy. And so we can talk about each of those three pieces kind of in its own.
That third rail here, I think, is the most important because in the vein of this year alone, there have been a lot of concerns about the pressure from Congress and from others to politicize the Fed. Maybe talk through, even though that this is something that is highly uncertain and also unclear whether Trump himself was made aware or approved of these plans, I think we need to talk about what the ramifications would be if you did see an administration involved in interest rate setting.
Well, the Federal Reserve's monetary policy design was set 90 years ago, in the middle of the Great Depression, and it's been essentially the same ever since. The monetary policy set, the committee meets every 6 weeks. They're going to meet next week to make their next decision. They set the level of interest rates. Their legal mandate is to promote maximum employment and price stability. And the way the committee is set up is that some of the members are from regional Federal Reserve banks around the country. Some of them are at the DC board in Washington. The Fed chair is just one of the 12 voting members. According to the law, the Fed chair is first among equals. Now, if Congress were to change that law, and of course they could, but it would require legislation. Without a change in the law, the president can't sort of suddenly show up at the meeting room and say, here's what I want you to do. It just doesn't work that way. It can't work that way under the current law.
And let's talk about some of the details in this Wall Street Journal reporting. Like you said, we're talking about, of course, sources familiar to the matter, haven't heard anything official here. But one of the reported points is that the Fed's financial regulations would be subject to the same review process that applies to other regulatory agencies. What's your take on that?
Well, again, this would require an act of Congress, but as a financial regulator, the Federal Reserve is overseeing large financial institutions. The Fed was partly responsible for the oversight of Silicon Valley Bank, which went bankrupt. I think that having the Federal Reserve's financial regulations reviewed before they come into effect, that's already done for the SEC, FDIC, CFTC, OCC. If Congress decided that they wanted the Federal Reserve's financial regulations to go through that review process, I think it would be reasonable. It's up to Congress to decide that they'd have to change the law.
Our thanks to Andrew Levin of Dartmouth. We thank you so very much for reading into the potential ramifications here of this report. And for more now, we are joined by Dennis Kelleher. He is the CEO of Better Markets. On one hand, I kind of want to ask you what your initial reaction was to this report, Dennis, but I also want to get your thoughts here on the process by which something like this would have to go through even for this to happen. It's another interesting part of this report was the pushback you got even within the Republican Party. You had some people very much in favor of this and some people even on the Republican Party who were very, very much openly against this.
Well, sure. Thanks for having me on. As to my reaction, look, nobody should be surprised that if Trump becomes president, he's going to try and bend every part of the government to his will. He's made it clear that he may change the civil service rules so that everybody who works in the government basically swears an oath to him, not the Constitution. It should be no surprise that he's going to try and get the people at the Fed, including the chair, to do his bidding. And in fact, during his first term, you'll remember, and you did some terrific reporting at the time, about how Trump actually considered firing Powell, his own appointee at the time, and that is basically pushed back behind the scenes by many senators, including Republican senators, that he should not do that and they would not support him. It's not surprising also to see senators, Republicans and Democrats pushing back against this because the concern is that if interest rates are essentially set politically, leaving aside the very good points my friend Andrew Levin just made about the difficulty of changing the law and things like that, if the president were able to politicize monetary policy decisions, interest rate decisions, then it's likely that interest rates would be higher, and therefore the implications for the economy, financial stability, and frankly, Main Street Americans wanting a mortgage or buying a car or their credit card rates would probably be substantially higher because investors want to get paid for the risk that the interest rates would be subject to the whims of politics, whether it's Trump or the next guy or whoever it is.
Dennis, is that part about the higher rates, is that part true necessarily? Because you have heard Donald Trump really favoring low interest rates here. And is there a chance here that instead what you end up with is a perennially low interest rate environment?
Well, only time would tell, although I think that sooner or later, if you have a perennially low interest rate environment, unless you repeal the business cycle, it's going to tend to result in greater liquidity than you otherwise would have. You'd have more dollars in the system. You would, at least according to basic economics, which are not always right, you're going to have inflation with too many dollars chasing too few things. And if you have inflation and you keep your rates low, which is to say you keep flooding the system with liquidity and cash at low rates, something's got to give. And probably what's going to give is going to be higher inflation and higher for longer. And investors are going to want to get a return for that risk, and they're not going to like it. There's something else that we should think about, though, and could get lost in this, which is there is a very good argument that the Fed needs to be more accountable, needs to be more transparent, and needs to be more responsive to ensure that it actually discharges its mission. We're talking about monetary policy. They're supposed to be focused on price stability and full employment. Price stability gets a lot of attention. Full employment, not so much. It's usually sacrificed on the altar of inflation.
Right, Dennis, unfortunately running up against the clock. Have to leave it there. Really appreciate your time. Our thanks, of course, to Dennis Kelleher of Better Markets. Now, still ahead, what investors need to watch for the week ahead? That's next. This is Bloomberg. Well, one big thing investors will be watching next week is tech earnings. You have Amazon coming out on Tuesday, followed by Apple on Thursday. And for a look ahead, we're joined now by Bloomberg technology reporter Jackie Davalos, a real hero, joining us on Friday afternoon. Let's start with Amazon. We saw, of course, Microsoft, Alphabet deliver. Will Amazon as well?
Well, you certainly have a decent picture going in if we're just looking at the cloud computing numbers that we got from Alphabet and Microsoft yesterday. Overall revenue for Amazon is expected to grow by about 12% to 143. But as you guys know, cloud Amazon Web Services is the company's cash cow. So when you look at what the company's expecting there, certainly in line with some of the growth that we saw yesterday coming out of those two tech giants, about 13% to $24 billion. And then the next closely watched metric is search advertising. It's expected to grow by 24%, and investors really want to know how they're faring versus other advertising dependent platforms like Meta, like Snap. But of course, they've been in their cost cutting era, so profit will also be top of mind. Operating income is expected to more than double from last year to about $11 billion. So really meeting that target is going to help analysts answer the question about whether that belt tightening is really paying off.
All right, yeah, a lot of big questions heading into that Amazon report. We really appreciate the preview. Our thanks, of course, to Bloomberg's Jackie Davalos. And let's look ahead to what else we're watching in the week ahead. On Monday, it's not just tech. You also have earnings from Domino. You also have on semiconductors, SoFi and Paramount. That's going to be a fun one.
And of course, Amazon on Tuesday, a big bellwether there, more tech earnings. Let's see if the party can continue. But the bigger day is Wednesday, isn't it?
Wednesday is going to be so fun. Of course, we have that Fed decision. I don't think they're going to cut. That is my big controversial hot take, of course, heading into Wednesday.
Tomorrow, you mean next week, or you mean in September, or you mean in December?
Eventually they will cut. It's a grand fullness of time. But let's look ahead to Thursday, too, because then we have Apple earnings, also very important.
Yeah, really important there. And of course, even more economic data on Friday with that jobs report. And what's interesting here is it comes after that FOMC decision. So you have to really wonder, if we end this week at almost 5% on the 2-year, where do we end next week?
It's a great question. So stay tuned. Of course, it's going to be a heavy macro week, a heavy earnings week, a lot to look forward to. But that does it for us. Balance of Power is up next. So have a great evening. Have a great weekend. This is Bloomberg.